Today, in the session, we will talk about how to do a financial model review for project finance and M&A transactions. So this is very focused on infrastructure sector. A bit about myself. My name is Abhinav. I am the managing director of YOG Infra, around 16 years of experience in infrastructure advisory. Uh, I am ex-PwC, ex-Synergy Consulting. So I used to work in Southeast Asia, South Asia, Middle East, North Africa quite a bit. So YOG Infra is an infrastructure-focused financial advisory firm. We have offices in Singapore, India, and in Dubai, working across the regions that you see here. And we work across all infra sectors. And I'm happy to see some of our existing clients are also in the class today. So today in the class, we will cover these topics. Number one being the types of reviews to be undertaken. The second being that if you're doing a model review, what are the must-do review checks? So I have made certain categories of like 7 to 8 items that we should always check when we are looking at a financial model. And then most of you would have a case study uh, that has been sent to you. It's an Excel file with a sample financial model and a map file. So I'll explain that during the call, how that works. And we will try to work some of the review comments during that time, okay, during the case study. Now, after we complete this case study, in case there is time left, I would like to also talk a bit about how do we do debt sculpting for project finance transactions. This is an area of interest to a lot of people who come to a masterclass. So we have a couple of slides on that. And this is optional. It's only dependent upon the kind of time that we have available after the class. And then we'll have a Q&A session for around 10 minutes, wherein you can ask your questions. In case we're not able to take all the questions, that's fine. You can send your questions after the class to info@yoginfra.com, and then we'll try to answer that after the class. Okay. So just a few housekeeping rules. Number one, that the webinar will be recorded and we will share the recording link with everyone who has attended today. You have the masterclass workbook, which has been sent to you via email. So I hope it has been downloaded by you. If not, please check your spam or junk folder. The email has come from an email ID yoginfo@yoginfra.com. So if you have any queries, you can ask in the Q&A panel. I think that's preferred, or you can also ask via the chat box. The chat is live during the meeting, so you can type in there if you have anything, questions or any comments. And once the class is over, based on the attendance, we will also share the course completion certificates to all the attendees for the session today. Is this clear? Because your mics have been disabled, it would be good if some of you can type yes on the chat box so that I know that everything is going well with the audio video. All okay? Okay, good, thanks. So now let's talk about first, what are the types of financial model reviews? So as a financial advisory firm, when we work with our clients, typically we classify model reviews into two categories. Number one, which is formal audits with reliance. This means that the model audit firm or the advisory firm, i.e. YOG Infra, is taking liability for any missed errors. So this form of model review is typically used for debt financing transactions or your equity raise M&A transactions. So this may lead to a higher fees for the model owners because there's a liability attached to it. And also the liability is typically capped at a certain amount. So let's say if you're doing a model under the liability cap, maybe 1 million or 2 million or 5 million USD. And that's how the fees is also varies depending on the liability cap. So that's number one, which is a formal model audit. So this is, as I said, sometimes also used for bid transactions in certain bids wherein the developer wants to get this kind of model audit done. The second is formal audits without reliance. So this is everything similar to a normal, with reliance audit. Everything remains the same. We still do the entire process. However, there is no liability cap attached to it, right? So it's without a liability, or it may be a very small amount of, let's say, equivalent to the fees that has been paid to the advisory firm or things like that. So, and this is typically used for important internal decisions. So let's say you are acquiring a project which is too small in size and don't really want to spend a lot of money on the model audit exercise, but you still want someone to look at the model that everything is working fine. So that's where this comes in. We have also done this for a lot of DFIs like ADB, PIDG, USAID, wherein they are investing into a particular transaction, but they don't really care about the liability per se. And then we have done work for them. Uh, then on the procedures review, the way that you typically audit a model or review a model, there are two ways of looking at it. Number one is maps and errors. So as I said, a map file has been sent to you, which actually tells you a lot of gives you a lot of quick insights into the financial model, that how is it being typically done, whether you have hard-coded values in the calculation sheets or not, whether the formula are inconsistent or not. And we'll talk about that during the class today. So as I said, this is being done primarily using a software. There are multiple softwares in the market that you can buy at a cost. So for example, we have, as a firm, we use multiple software such as Eri Excel, Mart for Excel, or sometimes Operisgit as well. The prices are quite varying, so it depends upon the kind of regularity that you are doing model audits for, right? So that depends upon that. And this kind of maps and errors actually is really focused on the integrity review or the mechanical review of the financial model. Then the second is cell by cell review. So herein, the model auditor or the model reviewer would actually look at formulae in each cell of the financial model to ensure that all the calculations are correct. When we do this kind of a cell by cell review, and in case we find a formula which is very complex, then we may suggest certain improvements in the model. So let's say you may suggest that you can use additional flags, or if we see there are like 4 or 5 nested ifs, we would actually recommend that to break it down into a series of calculations rather than everything doing it in a single line. So the purpose is twofold. Number one, to check for formulae errors, and also to suggest how to optimize the formulae which are being used in the financial model. Okay. So that's a cell by cell review. There is another way that certain firms do model reviews. It's called shadow modeling practice, wherein you try to create your own model as a model reviewer, certain calculation steps, and to verify whether the model is working fine or not. Okay, so that's another way that some firms do model audits. Okay, so as I said, when we talk about model audits, it can be classified into 3 categories. Number one is the integrity review. So we first check on the model structure and the logic, whether the inputs and the calculations and the outputs are very clearly marked. So there is no mixing of inputs and the calculation sheets. So it's an integral model. So there's high integrity and there's a proper logic flow of calculations. Identify and test the logic of unique formulae that they are working as well. So mostly in the model which have been done as per fast standards or smart standards, you will see that the first column would have the formula and that would have been dragged across the entire column in a particular worksheet. So that's what we would check, that is whether the first formula is correct or not. Identify potential formulae inconsistencies, that is done through a map file. Formulae errors, that can be done through a cell by cell review, and then whether there's any circular references on how these are being addressed. So this is important. Like as a model reviewer, we get models wherein clients don't prefer to use macros, so they would leave the model as an iterative calculation. The model will do the iterative calculation, give us the results. This is fine for projects, I would say, which are less complex, like a solar project or a standalone wind project with an investment size of, let's say, less than typically 75 to 100 mil. But beyond that, we recommend that you use simple copy-paste macros. These are very, very simple copy-paste macros, which can be used to avoid errors that may come up with iterative calculations. But yes, circular references in a typical project finance model will come in because of two things. Number one, being for the IDC calculation, interest during construction. And then the second being for the debt sculpting. So if you are sizing a particular debt based on the cash flows, then the macro may come in. May I ask from the room, has everyone heard of this term called debt sizing? Do you understand what is debt sizing? Yes, no? Debt sizing as per the cash flows. It's fine. Even if it's no, you can type a no. That's okay. You can type in the chat box so that I can understand. Okay. Yes. So I think, Vishal, you're right. Basically, we size the debt to meet a particular DSCR under a certain cash flows. So, for example, when we're doing a solar project, for a solar project, you have P50 and P90 yield curves. So typically the lenders would tell you that the debt has to be sized to meet a certain DSCR, let's say 1.25 under a P90 scenario. So the model has to run the P90 cash flows and then calculate the debt based on the available CFATs. And then that debt amount is used under a P50 scenario, which may be the base case for the developer. Okay. So that's how the debt is being sized. Okay. So that's one on the integrity part. We will talk a bit about debt sizing and debt sculpting also in the optional section of the class today, and you will try and we'll try to understand a bit more about that. Then we have the documentation review. So here, let's say we are doing a model audit for a bid submission, or we're doing a model review for a, let's say, a transaction. There are certain set of documents against which the model may need to be verified. So let's say when you're doing a revenue calculation. So in a revenue calculation for a virtual power purchase agreement, you may feel that typically what happens is the power plant may be on some other section of the land and the actual power is being supplied to someone else. So there might be offset of revenue using certain calculations, and all these things, the exact revenue calculation is being mentioned in the RFP documents. Similarly, if you're doing, let's say, a gas power plant, a combined cycle gas power plant, you may have different kind of charge rates. You may have a fixed charge rate, a variable charge rate, or a fixed O&M charge rate, or a fuel charge rate. So all these charge rates are being mentioned, and you have to verify that the calculations in the model are being done as per the calculation that is stated in the power purchase agreement. Okay. Similarly, for a water project or a waste management project, let's talk about a waste management project. So you will have, let's say, a tonnage fee, wherein you will have to, the revenue would be based on the tons of waste that is being processed by the plant. So there is a fee per ton which is paid by the government to the developer. Similarly, the developer also earns a revenue for selling electricity into the grid. I'm talking about a waste to energy plant. If it's an anaerobic digestion plant, maybe the revenue is in form of sale of the RDF. So then there's another revenue stream. So whatever are the revenue streams for a particular project, that revenue stream has to be specified in the financial model to calculate the revenue calculations, and there has to be documentation attached to it, wherein it is mentioned that this is the correct way of calculating a revenue. So often we see errors here. Let's say people assume an escalating tariff wherein a fixed charge cannot be escalated. We also see sometimes the exchange rate variation. So for example, you are doing a project in, let's say, Vietnam, and there is a provision for adjusting the FX curve in the PPA, but in the model that is not being done. So that also happens sometimes. Similarly, the CPI escalation, how it is being applied on very often in the Middle East projects that we do, in the MENA projects that we do, there's a certain start date of escalation that has been mentioned in the document. It has to start from 1st January every year, wherein in the models which are quarterly models, we see that the escalation is being applied every quarter rather than on an annual basis. Okay, so these are the things which are relevant from a documentation perspective. So once you understand the documentation, then you can actually understand the calculation, whether it's correct or not. This is very, very relevant for revenue calculations mostly. The rest of the calculations are very standard in the financial model. But yes, the revenue and the OPEX, that's something which has to be governed by the PPA. So liquidated damages also, termination payments, if that provision is there, all those things are governed by the documents for a particular transaction. And then you third have the commercial review. So in a commercial review, we try to see that whether the, like as you can see, whether there's a commercial sensitivity to the model and results or not. So for example, if you get a financial model and the IRRs are negative, NPVs are negative, the debt is not being serviced, so all these things don't make a sense. So we have to ensure that there's commercial sense to the financial model that has been sent to us. So that's called a commercial review. And this comes from experience because we have seen a lot of models. So that's why you're able to see that whether, like if your shareholder loan is not being repaid, then it's still a flag, but it's still okay. But if your debt is not being able to repay, then of course that's a flag. So it means that you don't have enough CFATs or cash flow for debt service to be able to repay your debt. So those things are very important. So that's a commercial review element. Are these things clear, or do you want me to repeat either of these? If it's clear, just say yes so that I can move on. Anyone? Integrity review, documentation review, and commercial review. Yeah, okay, good. Then how do we approach model reviews? So we have kind of done a list of categories of errors that we find in a model review. So you see 8 errors which are most common when we do a financial model review, and there is no like publication like that. This is based on just on my experience of doing model reviews. We have just categorized this. Someone may also have another category as well. I want to explain each of these category, and then as a case study, we will try together as a team to categorize certain of the review findings in one of those. So please understand this very clearly so that you can do the case study later. So number one being rule formula consistency. So this is based on the map review. Essentially, this means that if you have a formula in first column of any worksheet, the same formula should be applied across all the columns in that particular worksheet. Okay, that's a simple way. So you should not be changing formulae in middle of any row. Okay, that's called formula consistency. So if there are more formulae, then we need to understand why is that. Sometimes people try to take a shortcut that they will manually put a formula for the construction period, and then when the operations start, there's some other formula that gets started. This should not be there. Similarly, if let's say a model has a worksheet has 2 different timelines, so it has a monthly timeline during construction period and then a semi-annual timeline or a quarterly timeline during construction period, all within the same sheet. Then again, we have seen that people do a different formula for the construction period and then do a different formula for the operation period. This may lead to errors. Can anyone guess why? Why would it lead to errors in future? Why it might be an issue in future? Any guesses? Why is having inconsistent formulae an issue? Or we think it's all okay, no need to change that? Dragging a first column formula, assign to someone else who does not catch these changes. Okay, good. Yeah, so both the points are correct. Another reason is that if you run any sensitivities, let's say you run a sensitivity wherein your construction period gets delayed by 6 months, right? Or 12 months, then what would happen is the formula was supposed to change to account for the additional months, but then it has not been accounted for because these are different formulas starting operation period. So to give an example, let's say you have creating a project with a timeline of 12 months from Jan to December. So Jan 26 till December 26 is the construction period, and manually you had a different formula from Jan 27 onwards. Now, if you delay the construction by 6 months, the operation period formula will still be there in the model from Jan 27 onwards. So that's why we should not do it. It has to be dynamic across all. Okay, yeah, and of course, the reasons that people mention in the chat, that if a model gets handed over within the team, then people will not be able to understand why there are inconsistent changes, and it will definitely lead to errors. So it's a very common issue if someone leaves the team and someone else is taking over the team, then these issues also pop up. The second thing is unused inputs. So there we also see models wherein in the NTB sheet someone has, let's say, set of 90 inputs out of 90, 10 or 20 are not being used at all anywhere in the calculations. So that also needs to be checked, and these inputs should be removed. Okay, because you might think that the model has a certain functionality or it is supposed to behave in a certain way once you change that input, but it is not behaving. It doesn't impact the model at all. So that's an error, needs to be changed. No precedent on a non-input tab. So if you, I'll show you some examples wherein we have seen formulae wherein there are hard-coded values within the formula. So actually this is related to point number 4 as well, wherein people try to apply shortcuts and put hard-coded numbers and don't create an input for that in the input sheet. A very common example for this is like 1000. If you have to multiply anything by 1000, if you have to divide anything by 12, if you're converting annual to monthly, divide something by 12, you something, if you have a quarterly model, you multiply by 4 to make it annual number. So divide by million. So all these things are very, very common in the financial models, right? Which are hard-coded numbers within the formula. Now, again, our recommendation is always that if you have such items, please create a input. You can all easily do that and then link to that input. For ease of doing formula, you can actually name that input as well. And I can show you one example of a model that we have recently built to see how that works. So that it helps you to then use that digit very frequently. Okay. The only thing that we don't really point out in hard coding is if you're using flags. Let's say you say there's a flag of construction period, or there's a flag to end a debt repayment period, or there's a repayment period flag. So sometimes people say that if flag is equal to 1, then do this, otherwise do something else. Okay, so for those kind of things wherein people are using ones and zeros to refer to a flag, we don't typically highlight those things, because for that I think that's okay in our view. Some people might be more strict. However, we are okay with that, that if it's one or zeros that you're using in the calculation to refer to a flag or making it true or false, then that's fine. Otherwise, if you're putting a value, then it has to come in the input sheet. The fifth error is complex calculation, wherein the formula, so there are different ways of how you define complex calculation. I assume most of you would be aware about nested ifs. Have you heard of this term? Nested if. Nested ifs. That's a very common error. How many of you heard of this? Nested ifs. Yes. Okay. So nested if is exactly what Vishal said. It's if inside if. Now we have seen models wherein this if inside if goes up to the 5 levels. So if this happens, then there's another if this also there, if this also there, if this also there. So there are like 5 levels of ifs, and then the conditions come in. Okay, so if those kind of errors are there, that's called a complex calculation. Similarly, we also have a basic thumb of rule at YOG INFRA that if your formula is exceeding half of the formula bar, it means it's a quite complex formula, right? So that's our rule, that okay, half of the formula bar, if it's exceed, sometimes we allow it, but mostly we try to limit formulas to half of the formula bar. So again, you might have your own rules, but yeah, if it goes to the next line, definitely it's a more complex formula, should not be there. So I'm sure there would be ways to simplify it. And again, if you're using match index offset, if again it is referring to some other sheet, if it's within the same sheet, these references, then that's typically fine. But if you're using it some other sheet, then this may create 2 errors, and that's because you are, once you insert the or remove any rows in the other sheet, then this may lead to errors in the calculation sheet. So that's also needs to be taken care of. Then we talk about circularity. So we've talked about IDC and debt sizing. Those are two common sides of circularity. So any other circularities, then we have to check why that is happening and what is the best way to remove them. Then seventh is simply incorrect calculation. So the calculation is simply wrong. I gave you some examples that there is no element of consistency with the financial documentation, or another common thing that we see is regarding interest calculation. How many of you might have seen this, that in certain facilities it is being used on the opening balance, in certain facilities it's being used on the closing balance, and for some facilities it's being used as an average of opening and closing. So we recommend that it should be a consistent treatment for interest calculation, and it should be based on the opening or closing or average, but it should be consistent across the model. Is this clear, the interest calculation part? Have you done this, or can you tell me like how do you typically do? Is it opening or closing or average? How do you typically do that in your financial models? Anyone? Do you understand what is opening, closing, average? What I'm talking about here on the interest calculation? Is this clear? Okay, I don't hear any response to this. Let me explain again. So let me take you an example. So if you see the workbook that I've sent you, this is the old model. It's a very, very old model from 2020 that we adapted for our clients. So the statute of limitation expired on that. But let me show you the debt calculation here. See, now if you see the interest calculation, so this is the debt profile, wherein it says what is the opening balance, what is the drawdown amount, what is the repayment, and what is the closing balance. So, and this is the quarterly interest rate, 2.18%. Now the interest payable is being computed as the rate into my opening balance. So this is called opening balance, okay, calculation. And we have to check that, okay, let's say if there was another debt in this, there may not be that number. Okay, that's fine. There's only a single debt, but let's say you have shareholder loan also. Let's see if there's a shareholder loan. Okay, yeah, good. So let's talk about the interest on shareholder loan. Okay. So again, you see this is also on opening balance. So then this is consistent that both for debt equity, everything is being computed on an opening balance. So if you are multiplying this with closing balance, then for all the facilities, it should be on the closing balance. Or another third way is that you multiply the interest rate with the average of opening and closing. So that's called average method. Okay. So that's again a very common error that we see in the models, that this is not consistent. Okay. Okay. So let's say about here, what is, how is it being computed once? Right? Yeah. So this is also an opening balance. So that's fine. Okay. Good. Then the next one is incorrect or ref name errors. Again, this is, and this error creeps in when, let's say, you are working in an organization which is doing multiple transactions. They are doing M&As day in and day out, or they're doing valuations, or let's say they were doing bidding, a bid for infra projects a lot, and you tend to use a previous model to modify that for a new transaction. So whenever you use a previous model and modify to do a transaction, these kind of errors are very common because the previous model may have certain name ranges which are specific to that transaction, or it may have references from external files which have been copied into, whereas when you are using a model, all those things are not there. Okay, so those are not applicable. So those ref errors come in. So again, this can be also checked very quickly through softwares, that whether there are any ref error names, and if there are, then we should remove them. This is talking about the name ranges. So if you go to a financial model, you go to the formula bar, you would have the name manager. So you can see there are, even in this file that I've sent you, there are ref errors here. This is the error in the name range that has to be verified. So that happens because sometimes you are making a copy of a same worksheet where certain names are there. So both the names are working on. So here you can also see that days is a reference in sensitivities, whereas there might be other days which are working fine in the workbook. But in the sensitivity sheet, that's an error. So that has happened because you have copied the same sheet within the same financial model and one of them has turned to an error. Okay, you have deleted certain lines. So this is also to be taken care of. Okay, so I'll just ask the participants, is everything clear from 1 to 8? Any category which is not clear? Okay. Is there any other kind of error that you have seen in the financial models which should be there, which is not captured here in your experience? Okay, good. So let's show you some examples. So here you see a map file for a worksheet, uh, which is generated through a software, like I mentioned earlier. And you can see that there are hard-coded values within the calculation sheet in blue color. So the software is showing you that there are certain errors and there are hard-coded values. When you see this arrow, this less than sign, it means that the formula, just zoom a bit. Okay. So whenever you see this arrow, it means that the formula in this cell is same as the formula in the previous cell. Okay, that's how you read a map, that the formula in this is same as the formula in the previous. Okay, yeah. Thanks, Vishal. Yeah, we'll talk about this also in a while. Then if you see this arrow, the upper mean, it means again that the formula in this is same as what is mentioned on the cell above. So that's how it gets dragged lower. Okay. That's how you read a map. There's another sign which is called a plus sign. Plus sign means that the formula is in the particular cell is same as above and is same as left. Okay, so that's called, there's a plus sign that would come up in a map, and we'll see that in the map file that I've shared with you. So here you can see that this is the error I was talking about, that it is inconsistent and they are hard-coded numbers in the calculation sheet, which should not happen. You will also see that there's an inconsistency here as well. So here also there was a formula here, but it is changing after that. There's a new formula which comes up. Similarly, there are hard-coded values here. Typically, the formula should have been only in this column, and then that should have been dragged across. Okay, that's how you see that there's an error. So this is a very, very quick way. A map is a very, very quick way to find what are the errors in the financial model in terms of inconsistency. Okay. You can also see that there are certain items here, but there is no formula here. So that can be a potential cause of concern as well. Certainly here also there's, it's the same item of a cost projection, but then there's no formula missing here. So that's again, this should be highlighted, that whether this has been left out by errors. There has to be a formula here. Okay. Is this clear, the map file? How do you read a map? Yes. Okay. Then the next one is we talk about the hard-coded values. So now, so if you can see here, these are some examples wherein we have highlighted that you can see someone has multiplied by 5%, 95%, then 1.2% into 0.5. You will see 6 million, 4 million hard coded. So these are all errors that we would highlight in a review, that this should not have happened. It has to be a all these numbers of 5, 10, 95, or even this 2.5 should be linked to an input sheet. So there should be a certain logic that has to be defined, and then the formula should have been computed here rather than putting the numbers directly here. Sometimes this may make the uh, model a bit longer because you have to have a number of inputs. But I still believe that this is the best way to do it rather than directly putting the formula. Because if someone takes over the model from the original person who has prepared it, then they will not know which are the hard-coded numbers, and the model may not behave in a way that it's supposed to. So that's important. So that's about the hard-coded number. So you can see this is error number 4. So in our category list, we have classified as error number 4, the hard-coded in the formula, and this is error number 1, meaning formula inconsistency. So this kind of categorization also, I think we would do an exercise about how to understand this categorization. Okay, then the number 3 is complex formulae. So as you can see here, so this is a single formula that you see here. This is this kind of formula. Similarly, this also kind of formula. As you can see, they're nested ifs. So this is number 1 if, first if, then you have a second if, then you have a third if, and then you have a fourth if. Okay, so this is a complex formula. It should not have been done like that. Either you break down the calculation different rows and then you kind of add it here rather than doing it like this. Similarly, I don't even want to count this, but one, yeah, I think it's not because of if, but it's just that the formula is too long and you're using VLOOKUP multiple times within the same sheet. And you can see this number 8, this will also lead to error because if someone changes a column or a row in this construction sheet, then this will lead to an error. Okay, because you're referring to a particular row here. And if the rows change, similarly here also referring to a particular row. So this is definitely going to lead to errors, even if there is a slight addition or deletion of rows. And similarly here as well, you have nested ifs here. So you can see 1, 2, 3 ifs. And again, there, yeah, I think that's the only issue. There's no hard code and the formula itself is very long. So, and this is a proper formula bar. Like it's not like I have zoomed out a bit, but this was actually coming out in a formula bar that across multiple lines. So that's the first thing that you should see. And if their formula is like that, it needs to be corrected. Okay. And then, as I said about the name ranges. So this is another example from a model wherein you see there are so many ref error ranges throughout the model. The value is also ref error. The reference is also ref error. This was a very bad model that we got a couple of years back, and that's why using this as a case study. This was for a housing project in India, and this was badly prepared. So our initial scope of work was actually to review the financial model. But once we saw this, we spent around a few hours, like I think it was around 4 and 5 hours looking at the model. And then we told the client that, this cannot be done. We can't really review this model. Uh, and we will not charge any fee. You can take the mandate back, but we can't review this model. It's better that we do a fresh financial model for you rather than having to spend time to review this. So ultimately, I think the client also agreed, and we then got around to make a new financial model for them. May I ask, like, have you also come across an instance where the model is so bad that you just think it's better to create a new one rather than trying to rectify it? Has anyone come across this kind of situations? That it's better to create a new financial model rather than get the existing one audited or reviewed? Okay, I see one yes. Okay. Yeah, but I think as you do more and more transaction, you would actually come across a lot of these instances. Okay. So now, so these are all the integrity and checks that we talked about. What are the things that you have to check in the financial model? All good? Is it all clear? The examples that we showcased. Any questions here? Do you think that some of these formulae are okay, should be used? Any other conflicting views compared to what I'm saying? Happy to hear. Okay, good. So then let's go to the commercial review. Okay. So first is extreme event. This means to check whether the financial model will stand up to extreme events. Can anyone give me an example of an extreme event in let's say for any infrastructure project? Let's say a solar project or a water project or a road project. What would be an extreme event? Anyone? Okay, 30% drop in P50 value. Okay, good. Anyone else that they have seen? Is everyone aware about what do you mean by liquidated damages? Change in tariffs, no revenue, and also liquidated damages on us. Okay, good. Yeah, so typically we try to test extreme events in for a solar project, for example, when there is very little generation, like Shankar mentioned, there's a 30% drop in P50 value, or there is no revenue because of no generation. So how does whether the model is able to hold during that time or not? Okay, so that's a worst case model. And then there is a upper case model, and you assume very positive assumptions that everything is really going well, and suddenly you don't have to any cost to pay as well, right? The debt is finished, the debt interest rates go down, that kind of extreme positive events. Although most of the people would actually test the negative events rather than a positive event. Okay. Now in negative events, let's say you are having a solar model, and suddenly for a couple of years the or during the period we assume that okay, for 2 or 3 years there is no generation for some impact, or let's say there's a, like we see right now, there's a force majeure condition for certain projects, there's a war happening in the Middle East, and that's why projects are not working fine. You don't have there's no water to desalinate. Okay, that's not available. So for those kind of events, the revenue will be minimal or it will turn to zero. So how should the model behave in terms of IRR? How should the model behave? Should it's a very simple question. It should go negative, right? The IRR should go negative because there is not a revenue, or should go down. Okay, so these extreme events also, also need to check, like when you do sensitivity analysis, you try to kind of tweak these assumptions to ensure that the model is also behaving in the right way. Okay, so like for example, we check key parameters, we'll check the key ratios, we'll check DSCR, we will check returns, your NPV numbers, and how these are behaving. Okay, given the model is given if you change these certain assumptions. I want to give you an example. Let's say, okay, have everyone, are you aware of the concept called asset management fee? Asset management fee. Okay, I see one yes. Okay, good. Anyone else who is aware what is an asset management fee? Okay, that's fine. So let me explain. So typically, let's say if for an infrastructure project, um, as part of the O&M fee, there is one component which is called asset management fee, which comes back to the developer essentially. So let's say your O&M cost is $100, out of which $90 is actually your true O&M cost, and $10 is a fee that you are paying to the management, the holding company or some other company, uh, to manage the assets for you. So that's called an asset management fee. So essentially, it becomes part of your own return when you do the sponsor level return calculations. Okay, it comes back to you from the project SPV, comes back to the developer, because there are certain duties that developer is doing and supporting the SPV, given that SPV is the doesn't have their own staff to do management functions or certain items. Okay, so we see in models very often that in case of extreme events, let's say there's a new tax regulation, or let's not talk about tax regulation because that's more complex. But let's say if there's no revenue, right? People still assume that the returns are high because they're still getting their asset management fee, right? However, that is not correct assumption, because if your revenues are not there, you won't be able to charge an asset management fee, because the model will not even have enough cash flows to be pay the normal expenses. Okay, so when you are stuck with LDs, etc., then there's a greater scrutiny on your expenses, the way that they are being flowing out from SPV, and these things are typically disallowed. Similarly, we also see a use of equity bridge loans, EBLs, in a lot of the transactions. Uh, Again, let me ask everyone, does everyone understand what is an EBL, equity bridge loan? Have you heard of this term, EBL? Okay, good. So there are people who understand this term. So essentially, EBL is a way that you take a short-term loan from the bank for, let's say, 3 or 5 years during the construction period, and that gets paid, let's say, after 3 years after construction. So you don't have to put your own equity during the construction period. You also get equity amount as a loan from the bank. So that's called an equity bridge loan. You are bridging your equity requirement through a loan, as simple as that. So we have seen that people, when they return calculations, they assume that during the first 3 years, in case there is an excess cash flow available after your debt service, etc., uh, you are paying it out to the shareholders. Okay, which is again not correct, because if you're an active EBL, then EBL holder will not allow any dividend payment till the time EBL is active. So those kind of things also need to be taken care account, and this is related to the documentation part, because you will have an EBL loan agreement against which you have to check that whether distributions are being allowed during an EBL period or not. Okay. This is a very common error that we see in the Middle East projects, that a lot of the reputed developers assume IRRs on FCFE basis, assuming that the cash flows during the time when EBL is active, those cash flows can be paid out as dividends to the sponsors, which will not be the case. Okay, so the returns are overstated. They are not true returns. Okay, so moving on to the relationships. So yeah, I think we have talked about this. So essentially, everything in the model is linked to each other. So we have to, like I mentioned earlier, if you change a variable or if you change an assumption, the other numbers should move in tandem with that. So that's something that you have to check. Okay. So that's called relationships, that whether everything is behaving in a proper relationship. There's an example here that if there's a price increase, of course, it will lead to a revenue increase. Okay, or more production should lead to a greater variable cost. So if your production is higher, your variable cost should also be higher. So in the model, if you have a calculation of VOMCR, which is variable O&M charge rate, then VOMCR should go up if your production goes up. Okay, because the charge rate should go up, the variable costs are increasing. And then we have capital structure. This essentially is to test your financing assumptions and associated computations. We always recommend that to our clients, that in your model, always run a case of 100% debt or 100% equity. Typically, people only run 70-30 debt equity ratio or 80-20 debt equity ratio. But the model should also be able to run 100% equity and 100% debt scenario, because very often errors will come out if those if those scenarios are run, which were not visible earlier. Okay, this is very important, especially in M&A transactions where you're playing with leveraged buyout or LBO kind of transactions. So wherein you have to run these scenarios. Okay. Any questions here before we move on to the case study? Any questions? I'll move on if I get 5 no's. I already have 2, another 3 people. If everything is okay, can you just type? In financial model review, do you do any technical DD on inputs? Okay, that's a good question. Typically, as a financial advisory firm, we can do a DD in terms of overall technical inputs, like for example, in terms of capex per megawatt, that whether that makes sense or not. So as a firm, we don't do a review of each component of a capital cost, like what is a solar cost, a solar panel cost, inverter cost, balance of system. We won't do that, but we can tell our clients that if you're looking at the financial model, we know the overall cost, whether it makes sense on a per megawatt numbers or not, because we have done so many projects, so we know that whether this makes sense or not. Okay. Similarly, you're able to find those benchmarks. Similarly, you can do a DD on the O&M inputs, that whether the O&M per megawatt makes sense or not. Okay. On the yield curve, again, you can do a scenario that, okay, if we are, let's say we are doing a project in Philippines. Okay. So we have done, let's say, 5 solar projects in that country. And then a 6th project comes to us wherein it's in the same vicinity, but the yield curve assumed is too high, or we call a specific generation yield curve, meaning kilowatt hour per kilowatt peak. So if that number is too high or too low compared to what we have seen in other models, then we'll point it out to the client. Okay. But again, this is not a part of our score. This is just on special request that the client asks us to do that technical or overall benchmark review, but we don't classify as technical review. We'll just do an assumption review. So we classify it as an assumption review for projects. So in assumptions review, we will review all the overall capital cost benchmarks, O&M benchmarks. We will review the interest rates, whether they are within the range for certain projects or not, your inflation assumptions, your FX assumptions, then your debt tenors, like all the debt financing assumptions in the model. But yeah, that's it. I think these are and tax and accounting as well. So we'll do a tax and accounting assumption review that, like for example, if you assumed interest deductibility. So there are specialized firms who only do tax and accounting review as well. Sometimes in our scope, we include tax and accounting review, wherein we'll check the tax assumptions, VAT assumptions, the calculation methodology, whether the tax holidays have been applied correctly or not, whether the interest deductibility in terms of accounting, the depreciation rates, depreciation methodology, whether all that is correct or not. So that's a tax and accounting review, which we will either do in-house for certain countries, or we will partner with some other firm as YOG Infra and get it done. But it would be under our contract. It would be under our scope. Is this clear, Shankar? Okay, any other questions before we move on to the case study? Okay, good. So now I would request all of you to open the files that have been sent to you. So please open the financial model that you have, and also open a file called review file. Sorry, map file, not the review file, map file. You must have seen a map file as well being sent to you. Okay, good. Now, you can ignore. Okay, let's talk about one by one sheet. Okay, so we will talk about each sheet, and it would be good if we can make it a bit more interactive, and I get some responses from the audience as well. So let's go to the TB sheet, and can anyone tell me that by looking at this map very quickly, where are the errors in this TB sheet? You can look at it. I'll give you 2 minutes, but what are the potential errors in TB sheet? Just as a hint, it starts really after row number 70. You can look below row number 70, you would find certain things. Row 48, 0 and 1s. Okay. Okay, that's good. Okay. Anyone else? Let's try to find 3 errors in this sheet. There are more than 5, but I'm happy if you are able to find 3. I'm talking about map TB sheet. Row 109, yeah, that's a related error. Again, zeros and ones. And there's also an error that, so thanks here. There's another error that apart from hard-coded numbers, you also see that this is all blank. So this is also cause for concern. The 2 things here. Good. Row number 93. Okay, let's try to zoom out a bit. What's happening in row number 93? Okay, so now the error is that here, this formula is referring to the formula above rather than it should refer to the formula on the side. So it means that they're inconsistent formulae. And then after that, it is all okay. But we have to see what's happening in this formula in the financial model. Okay. So let's go to this. This is K93 in the TB sheet. So let's go to the model and try to see what's happening here, whether this is really an error or not. So TB sheet K93. NTB. So this seems okay. So because the formula is being dragged, so no issues at all. And this is correct. So 93, unfortunately, is not an error. Okay, what else? How about row number 88? Do you see in row number 88, they are inconsistent formula up to the third column. So definitely there's something happening here that we need to check. So row number 88. So this is referring to this, this. So K71, J88, H88. Yeah, okay. So now the reason that this has flagged, can you check what is the difference between the two formulae, K and L? Anyone? In row number 88 in the model, what is the difference between these two formulae? Any differences or there's no difference? Row number 88, KL and L column in the TV sheet. Why does the map show that there's an error here? Okay, actually that's happening because here if you see H88, this H88 4% has been tagged as $ before H. So basically the column has been fixed. Whereas here the formula, both row and column has been fixed for the inflation rate. So that's why the map shows that there's an error. Okay, so we will keep it as a low priority comment in our review file, but we will still ask them to modify it. So even if you copy paste the formula, the value will not change, right? The value doesn't change, but still we kind of want to flag it because this is inconsistent formula across. Can I get at least 5 yes that this is clear? What was the issue in K and L? Did you understand what I've just said? Okay. Okay. Okay, then let's move on to some other sheet. Let's go to construction sheet. Anyone besides Eva on the errors? What is the error in construction sheet? Which row number and why? Construction sheet. Map construction. I hope everyone has a review file, right? This at least we sent it out to everyone. So I hope everyone has it. Construction sheet. Anyone? I need at least one answer before I can move on, please. Or you can also say that there's no error. Row 64, row 50, and 64. Okay. So 64, yes, because it's 64. Is it an error? Really? Let's talk about that a bit more. Row number 50. So 50, yes, it is an error because there's a hard-coded value. Actually, 64 is not an error because if you see the description, it says IDC calculation, calculated and pasted value. So the pasted value is anyways going to be always hard-coded. So it's not really an error. It's just that you assume that this is a hard-coded value, but really it's coming from a macro. So we don't highlight this in our review because this is not an error in that sense. Clear? On row 64, not being an error. Okay, good. Okay, let's go on to debt sheet. Any errors here on the debt sheet? I think this is relatively fine. I don't see any flags here, any issues here. So should be okay. On the cash flow as well, we are pretty okay. P&L also pretty okay. Balance sheet, yes. What are the errors here in the balance sheet? 1 minute, balance sheet. It's okay, you can take your time. You can take 1 minute or so. Map BS balance sheet. What are the errors? There are only a few of them, so I'm happy if you can get only one as well. Row number 47. Okay, so let's see what's happening in row 47. DJ47, yeah. Correct. So we see that there is a formula which is starting here randomly during the row and that it is being copied. So let's see what's happening in the financial model. PS row number 47. Row number 47, DJ column. Yeah, okay. So I think this was a check that has been entered to see what is the difference between balance sheet total of assets and liabilities. But either this should be starting from first row or this should be at the end of the row. Okay, so let's finish this first on. I see some other comments also. But for D47, can you actually tell me, is it a low priority, medium priority, or high priority comment? Let's also start classifying. L, M, or H. You can type that. Low, medium, or high. This kind of error. In your view, is it low, medium, or high? Yes, it's low. Good. It's a low error because it doesn't really impact any calculations. Doesn't have any bearing on the model results as well. Okay. So there was one more comment that all the totals are referred from the left instead of being a summation. All the totals are from, this is in balance sheet. Okay. So I didn't understand that comment. Yeah, well, what exactly are we trying to say here? Common. Totals to the left. Can you give me a cell reference maybe? So that goes from the left. Anyways, I think let's move on. I'm not able to understand that comment. Carmen, you can type your response later if that's okay. Now let's go to the equity sheet. On the equity sheet, looks okay. On the depreciation sheet, yeah. So there are many errors in depreciation sheet. So can anyone tell me at least, again, take a minute or so, it's okay. Tell me the errors in depreciation. And I think that there are 4 or 5 errors here. So if you can get them, be helpful. So row 11 hard coding. Very good. Okay. So there's hard coding and then there's a formula, then hard coding again, and there's a formula, right? So what's happening in N11? Let's check in the depreciation sheet what's happening in N11. N11. Yeah, so there's a hard coded 1 here, then it's 0, then hard coded 1. And we have to see why is it happening here. Where is it being used? It is being used for your transfer, asset transfer. Okay. So it is basically a flag which is being used to capitalize your assets. And this is not the right way to do it. So there should have been another way. Okay. So that's good. Good finding. Anyone else? Any other finding? Row 42. Row 42, the depreciation calculation. Yeah, so we do see that in the middle of the row itself, there's this error. No, there's a new formula. So it means the formula is changing between this and this cell. And again, it is changing in this cell. So that's also an error. Okay, good finding. Anything else that's there in the sheet? Rest everything looks okay to me. Okay, good. So then this is on the map. So as I said, this is how you test on the integrity or the logic flow of the. This is more to see whether the formula are consistent towards the row. So this is a very quick way to find all these errors. Okay. Now let's go to, so this is some examples of the review things that we did for the client. So I want you to, let's take for the, I'm not sure how much time we will have left, but okay, let's try to spend 20 minutes and see. I want to work with you to tell me the categories of these errors. Okay. In this column. Okay. We'll try to fill this column. That out of the 8 categories we had, this error forms in which category and whether this low, medium, high is correct or not in your view. So let me just copy the categories here first, but we can work with this. Okay. Okay. So now you have a reference to the categories. Is my screen visible? Is everyone able to read what's written in the comment? Or should I zoom it a bit more? Okay. Okay, good. So the first one, no dependence in NTB worksheet H14. So let's go to H14 and go to the NTB worksheet H14. Okay, so it seems that there is no dependent. Okay, so can anyone check? Can anyone confirm? Are you able to find a dependent or there is no dependent? Is this correct? Dependence part. Everyone agrees that this is an error? What I can gather is that it seems this project has 2 phases, 0 and 1, and this flag tells you whether to do phase 1 or both phases or first phase, and it is not being, there's no dependence to it, right? So which category of error is this? Very simple. From the 8 categories that you see here, how would you classify this? Okay, good. Number 2. Good. Let's move on. So there is an incorrect formulae in NTB sheet 63 to 65, J63, J65. Okay. Why is it incorrect? What's the formula here? So this formula says that my actual households sensitivities, if is equal to yes, it is linked to 15%, otherwise it is as base input. Okay. So sorry, I has to refer to column number J. So this is sensitivity in the tariff escalation. Yeah, okay. So this is an error. So this is a sensitivity of a tariff escalation, right? But when you see it is linked to H8, which is a sensitivity of the cost overrun. So instead of tariff escalation, which is this 5%, it has been linked to the cost escalation. Is this error clear? Yes, no? Okay. Now, what is it? Is it which category? Which category will you classify it to? Good. Number 7. Excellent. Let's go on. Okay, so the next category suggests to change cell color or legend as calculated values instead of inputs. Is this comment clear? Like, does anyone understand what is a legend? Color legend. Do you know this term? I hope most of you do. Yeah, I see one. Yes. Color legends. So typically, if you see here in the model, there is a sheet which is called legends, wherein it has been clearly mentioned that how is each cell being referred to. So for example, if it's an input cell, it is in yellow color. If it's an external link, it is this, or coming from some other sheet, it is an orange color. Okay. Now this particular cell which is referred to in this file, which is NTBH144. NTBH144. So we see that this is a calculated cell, but it has been formatted as an input cell. So that's why we are asking the model builder to rectify it and convert it into a proper formatting. Which category of errors would it be? Out of 1 to 7? Actually, it's just a formatting error. It doesn't fall into these 7 categories, more of a formatting. Typically, if you're looking at a project which is very bad, sometimes you won't even highlight it. But yes, it's good to, it's just a formatting change. It doesn't fall into any of the 8 categories. So maybe this is a correct label. The label is not correct. So the label means the row item is not correct. Again, a very low impact item. So you don't really classify it as an error per se. No dependence, H144. Let's talk about this. We go to the same cell, H144. Is there any dependent to this? Should there be any dependent to this cell? Where should this be used? Last date of depreciation. How this should be used in a financial model? Anyone? So let's say you have a project and it's a 25-year concession, and at the end of 25 years, what should happen to your fixed assets? What do you assume typically? I'll ask the question another way. The value shall become 0. Yeah, correct. So typically, if this is used to ensure that the residual value becomes 0, because for a typical PF transaction, we assume that the asset life is equal to the concession period. In some assets, we do have a, okay, maybe let me ask it in the form of a question. So if there is there a project you have seen wherein the asset value doesn't turn to be 0? And if yes, then what is that residual value used for? So let's say you have a project which is a $100 fixed asset and the concession period is 20 years. You have assumed a 25-year life. So at the end of 20 years, the model will show a certain balance. What would be the typical use of that balance? Why would the balance be there? How will it be used? Just as an experience, like, have you seen this? And if yes, if you're not seeing this, what should be the use? Transfer value, yes, correct. So for shorter term assets, typically, mostly very commonly in CNI solar projects and certain water projects, in terms of when you see battery projects which have a longer life, or LDES, which is long duration energy storage. So LDES storage, for example, has a life of around 30 years, but the contract concession may be only for 25 years. Then you transfer the asset and you get a terminal value or a residual value of the assets gets paid out to the developer after the concession period ends. So thanks, Shankar, very good answer. Okay, let's move on. So no dependence, which category? Very quickly. so that we can move on to the next part. We've already done this. No dependence. It's 2, right? Category 2, unused inputs. Sorry. So next is also unpaid inputs. Okay. Now, as for the term sheet provided in the data room, so there was a data room attached to this model review. And as for the term sheet provided, the debt equity ratio is 70-30. And in the model, let's see what has been assumed. H190. H190. What is the equity ratio here? You can see it's 47-53, right? It's not 70-30. So although the debt term sheet stated that the debt equity ratio should be 70-30, it is actually not that amount. Okay, it's a different amount. How is this classified? Which category? Anyone? Actually, it's not here. So this is the second part of the work that we did. This is called related to documentation. Remember, if you look at the slides back again, so this was a mechanical or a formula review, but then there is a documentation review also when we do commercial review. This is the second category. See here, when we talked about this uh, model integrity review with the 8 categories, documentation review, and then the commercial review. So this falls in the documentation review. So let me just type here documentation. So that's fine. So this is again, the next one is also documentation review in terms of capital structure, because this is referring to a term sheet. The third one also refers to a term sheet. So this is also documentation. The next one, category 10. So what's happening for this project is that there's a DSCR of 1.1 that has to be applied only during the grace period. Okay. And for the repayment period, the DSCR limit is something else, right? So that's why we have suggested that you should take 2 inputs for DSCR. So let's see whether there are 2 or 1 input. H249. Okay, so see the minimum DSCR requirement 1.1x has been used throughout the model, both during grace period as well as during the repayment period. However, the term sheet for this project had different DSCRs been mentioned for grace and during the normal repayment period. So that's why we have suggested the target DSCR number or either the minimum DSCR requirement should be split for the check. Clear? So what category would this be? Anyone? We will typically classify it as 7 instead of documentation because documentation says something, but and for that the calculation is incorrect. Okay, so this is more, that's a high priority because this may lead to errors or the lenders might point it out later. That is not correct. We have time for doing let's say 2 or 3 more. Do you want to kind of stop here or do you want to continue another 3 or 4 errors? Or if you want, we can cover the debt sculpting now, the debt sculpting basics. To you guys, you want to continue or? Debt sculpting, okay. Okay, good. So that's fine. So I just want to verify that the numbers, whether we have, okay, so this is only till the debt sheet. So you will see that some of the inputs, some of the items that you identified in the construction sheet, see the hard-coded values and certainly that. So their hidden row also, I think that's very common. So we always recommend to remove the hidden rows as well in the model. To avoid any errors, because this may also, if they are dependent on hidden row, that may also have an issue. Okay, so let's pause here. Okay. And let's talk about something about debt repayment profiles, right? So let's talk about that a bit. And then I think I can show you some examples of how it is being applied in practice as well. But yeah, first let's talk about the basics. Okay. Does everyone understand what is equal principal repayment profile? Very simple. Equal principal repayment profile. So let's say if there's a 10-year $100 loan for 10 years, what is the principal repayment every year? Very simple. $100 loan for 10 years. What is the principal repayment amount every year? Yes, good. $10, right? So simply every equal principal very simply means that your repayment is equal for every year. So that you can see on the table as well that you have an opening balance. It's 1250 every year. So 10,000 has been repaid accordingly. So so let me just take away the file. In an equal principal payment, what is the behavior of interest? Will it be higher in the initial period or lower in the initial period? How does the interest behave? Is it higher or lower in the initial period? Good. Higher initial and then, of course, good. Then let's go to EMI repayments. What is the formula that you typically use to calculate EMI repayments in financial models? There's a standard formula that everyone uses to calculate repayment profile. PMT. Good. Now, in a EMI profile, whether principal is higher or lower, or is it same in the initial period? What is the profile of principal? Can you tell me? Principal amount, is it higher, lower, or equal across all the periods, or is it higher in initial period? Balloon, higher at the end. So you're saying principal is higher towards the end and lower in the initial periods. Correct? Yes, Vishal? Are you trying to say it's yeah? Okay. So it's lower in the initial periods and higher. Let's check that out. So yeah, that's correct. So in the principal repayment, you will see very simply that it is lower and then it goes high. Similarly, the interest is high, goes low, and the total amount that you're paying remains the same. Okay, across all it's the same amount. It's a very, very standard calculation that you must all have come across in your personal life as well when you're doing insurance calculations for yourself. Okay, good. Now debt sculpting. Okay. So debt sculpting is a way wherein you calculate the repayment obligations such that your repayment profile, your both interest and repayment profile, is a match to your CFAs, cash flow available for debt service. I'm typing a term. I hope everyone understands this term, CFAs. Does everyone understand this term? Yeah, okay. So debt sculpting is a way that you calculate. So it is neither an equal principal, it is neither an EMI principal, but it is a way of calculating your repayment profile such that it is a very close match, or it moves as your CFATs moves. Okay. So let's take an example of a mini grid project. You know what is a mini grid? Or is this too complex? Mini grids. Has everyone heard of this term, mini grids? Yeah, okay. So mini grids are projects wherein it's like a separate distribution system which is set for a rural community. Now, in a mini grid system, as per your understanding, what would be the profile of cash flows? Will it be constant? Will it be high to low, or will it be low to high? Option number one, constant. Option number two, going from high to low. Option number three, going from low to high in a mini grid, the revenue, low to high. And why is it low to high? Can anyone tell me why is it low to high? It's exactly correct. It's low to high because, yeah, once people start getting access to electricity, slowly and slowly they would buy, let's say, more washing machines, more refrigerators, more mobile phones. So the electricity consumption will also do increase, and you will also connect more and more people. So yeah, thanks Shankar and Cynthia, both answers are correct. Okay, so there is another project like this wherein the demand goes from low to high. Which project is that? Can you give me another example wherein the revenue goes from low to high? Okay, no issues. So another example is a toll road project. So if you're doing a highway project, which is based on market demands, wherein the people are being have to pay tolls, so you will see the revenue will also increase over a period of time because more and more traffic starts coming once they see the performance of the road, like more and more start people using it. So they're in a toll road project. Okay, what is the profile of, let's say, a solar project? If you try to do a solar project throughout the year on a quarterly basis, what does the profile look like? Is it constant? Is it irregular for a solar project? Yeah. So Cynthia, actually, it's not constant, it's irregular. Yeah, yeah, exactly. Which Shankar mentioned because of weather factors. Because what you have is, let's say you're in a year. It depends really on the jurisdiction as well, but in most jurisdiction, you have different irradiations for different seasons. So for the first quarter, it might be 20%. For the second quarter, it might be 25% up. So there's a general distribution of solar irradiation throughout the year, and that's why the cash flows are varying. Okay. So in the same scenario, let's say you're doing a project wherein you have to maintain a particular DSCR for every quarter, then you can understand that you have to ensure that your principal repayment will also change every quarter so that you maintain a constant DSCR throughout the project. Okay, and that's what we try to call as that sculpting. So you're trying to sculpt your repayment profile such that you have a constant DSCR. Okay, so irregular, but so self sculpting is required in the following situations when the cash flows are irregular, but they're understood. They know, like people understand how they should work. Then seasonal demand factors ramp up for a new project like a toll road or a minigrid project, and an unusual and unexpected payment, such as major overhaul of an asset. Uh, so let's say you have a project wherein you have a major overhaul done after 5 years. Okay, and you have to spend a lot of money to do that overhaul. So suddenly you need more cash, which will be spent to uh, do that overhaul or a major maintenance. So how do you avoid that seasonality? How do you avoid falling short of cash during the, let's say, 10th year of operation? There's a very common way of doing that in the financial models to ensure that whenever major overhaul comes, you don't fall short of cash. What is that called? What is that methodology called? I'm going to type a word in the file. Please tell me if you have heard of this or not. And if you have heard of this, what is the full form? Okay. So this is called major maintenance reserve account. Typically, let's say you have to do a, yes, Isaac, thank you. So yes, major maintenance reserve account. So typically, let's say you have to do a maintenance in the 10th year of $100. You would start reserving $10 per year, such that at the end of 10th year, you have those $100 and you can do the major maintenance from that account. So this avoids your sudden drop in your CFADs because you've already reserved for that cash and you don't have to take money from your operating expenses. Okay. So usually we see that that sculpting is important for those projects wherein there's no MMRA, there's no provision of major maintenance. This is typically applicable for smaller projects as well. So we have to take care of that. Okay. But for very large projects wherein the major maintenance is very well known in advance, very precedent projects, then you typically would have an MMRA provision. So when you do the debt sculpting, uh, so you are ensuring, so let me just try to show you a curve. Let's say, let's open the same model, maybe if there's something. Yeah. Just hold on. So let's go to the cash flow. We go to my, so this is not the right calculation of a cash flow waterfall typically you want to have, but yeah, let's try to map cash flow from operations. Okay. The CFADs would also typically behave in the same way as cash flow from operations. In the cash flow waterfall, you have a separate line item of cash flow available for debt service. It is not here, but it's okay. I'll just try to show you this line. Okay. So we can see that this is a project wherein there is a ramp up of your revenue. So it's going up over a period of time. Okay. Now, if I try to map my debt service, so my debt service is increase in equity. That's financing. Increase in shareholder loan. Decrease in long-term debt. Yeah. So this is my debt repayment. So I'll take from the same year, and I will go to my insert to a chart here. Okay. So sorry. Okay. So actually what's happening is after this period, debt is no longer applicable. That's why it's dropping to zero. But let's focus on the few years initially. So you can see that the debt repayment is also increasing over a period of time. So it means that debt has been sculpted. It is increasing over a period of time. So now let's go to the debt sheet and try to understand what is the DSCR here. So is it a constant DSCR? So see here. So this is a sculpting which is being done on a 1.1x. This is a simplified calculation, but it will help you to get the context. So we have a CFAD available in this quarter of 6654. So we have divided it with the target DSCR of 1.1. Okay, and we know that this is the total amount that I have for the debt service available, both interest and principal. So I reduce the interest amount and then I get the principal repayment profile. Okay, so based on this, then you can see my principal is increasing over a period of time. That's how it is increasing because it is sculpted. So if I see the DSCR calculation somewhere, you would see DSCR is constant. So you see here, the DSCR is constant at 1.14. There are certain drop down, so it has to be done a bit more properly, but yeah, so this is the item, this is the end result, which is 1.1 throughout the period. So you can see it is being sized at 1.1 constant. Okay. Now, there are a couple of things that has to be taken care here. First of all, is this clear? How do we do typical sculpting? So simply you take your CFADs, you divide it by target DSCR, you get the total debt service, target debt service, you reduce the interest from it, and you get the principal repayment amount, which goes into your debt service, debt schedule. As simple as that. Understood? Yes, no? Why are there no yeses? It's not that complex. We are essentially using CFATs as our upper limit, dividing it by DSCR to get the total target debt service. Now, out of the total target debt service, it includes both interest and principal, and you reduce the interest amount, and then you get your principal repayment profile. There's an element of circularity here, of course, because interest is also a dependent upon principal repayment if you're doing a closing balance interest calculation, but that can be solved through a macro. So that's a modeling practice. Yes. So here the interest is being determined in this model, the interest is being determined on an opening balance. So the repayment amount doesn't impact the repayment amount for that quarter doesn't impact your interest calculation. But if you're doing an interest calculation using closing balance, then the repayment amount will also impact your interest calculation. So there's circularity in it. And that's why you need a macro if you're doing interest on a closing balance calculation. But here, because it is doing an opening, so this interest amount you can see is being computed here very simply, that my interest payment is opening balance into my interest rate. So based on this, I have determined the quarterly interest amount I have to pay, and then the repayment is coming as total target debt service minus my interest amount. That gives you the principal repayment. Isaac, is it clear? Understood? Okay, let me explain you one more concept, and then I think I'll take some questions because this is not complete yet. I need to explain you one more concept so that you understand debt sculpting fully. There are two types of debt sculpting. One is flexible tenor and one is fixed tenor. So the one that I just showed you, it is called flexible tenor debt sculpting. Any guesses why is it called flexible tenor debt service? Any idea? Tenor may be prolonged or shortened. Yes, good. So I think we need to first understand that from a debt perspective. Let's say if you have a fixed tenor, if you have a tenor of a debt specified in the term sheet, it will never be prolonged, because if you reach that date in which the last repayment is due, and if you still have a huge balance, you will have to just repay as a bullet payment, right? You will, or either you will refinance. So the tenor will not be prolonged. The tenor will always be shortened in a flexible tenor debt sculpting when your CFATs are higher than what you have. What you can, your CFATs are higher than your debt size. Okay. So let me explain you in a simple language, a more simplified language. So let's say if you have done a debt sculpting in a financial model and the original tenor of debt was 18 years, but in the model the debt gets finished in 12 years. Okay. What does it mean? Does it mean that you can increase your debt ratio, or you should decrease your debt ratio in the capital structure? So one means that you need to increase your debt ratio, and two refers to decrease your debt ratio. Okay. And the scenario is that your original tenor was 18 years, but your debt got repaid in 12 years. So as per the input assumptions, the tenor was 18 years, but it got paid in 12 years. So what does it imply? Should you increase your debt ratio? Can you increase your debt ratio, or you need to decrease your debt ratio? Debt ratio is means 70-30 debt ratio, like 70% debt. Anyone? We'll not talk about equity IRR, Vishal. That's not the question. The increasing debt ratio would always help us to get an equity IRR, higher equity IRR. That's fine. But right now, my question is that whether you can increase or you need to decrease. What does it imply? If your debt is getting in prepaid in 12 years and your tenor is allowed tenor is 18 years. So Isaac says can decrease. Okay. Anyone else? Number 2, decrease. Okay. One more response. Anyone else? One more response. Anyone? Okay. Yeah. So actually, unfortunately, all the 3 answers are not correct. If your original tenor is 18 years and through a debt sculpting mechanism, if it is getting paid in 12 years, it means that you're losing 6 years of repayment. It means your cash flows are much better. So you should need to increase your debt ratio. You can take a higher amount of debt and you will still not default on DSCR. So the correct answer is 1, that if it's 70%, try going to 72, 73, 75%, such that you are able to make full use of the tenor, 18 years, for the debt repayment. Because right now it's getting repaid much faster. So it means you have more runway. So you should be able to increase your debt ratio so that you are able to make use of the full tenor. So that's called a flex. That's the implication of flexible tenor. So if you're doing a flexible tenor, then typically your debt repayment will get faster, and then you have an option to increase your debt ratio to make the full use of 18 years. Okay, but it has to be, you can't increase to such a high amount that it goes beyond 18 years. That's also not allowed. So your DSCR should always be that number of 1.1 in the file below, that in the example that we are discussing. So all these calculations are done in the financial model. Some of it done through macro, some of them is done through formula, but that's what we do. So we size the debt in the model. When we talk about debt sizing, essentially we are trying to find the correct ratio for leverage such that we are able to make use of the full tenor of the debt while maintaining a minimum DSCR across all periods. That's the definition of debt sizing. I'll repeat again. Debt sizing refers to finding the right debt ratio in the capital structure such that you're able to make use of the full tenor and also maintain a minimum DSCR that is required by the term sheet, as per the term sheet. Okay, so that's called debt sizing. Now there's another kind of debt sizing which is called debt sculpting, which is called fixed tenor sculpting. So here you would always maintain the same tenor. You will do a debt sculpting such that you always reach 18 years. Okay, so in this case, let's say your minimum DSCR is 1.1. If you're doing a fixed tenor debt sculpting, okay, in the original formula, in the original scenario only, let's say you have the same original scenario, and in the same model, you're asked to do a fixed tenor debt sculpting. So in that scenario, whether your DSCR would be more than 1.1 or it would be less than 1.1. If you're asked to do a fixed tenor debt sculpting in the same scenario, everything is the same. So debt has not been increased, it's still at 70%. Your CFAs have not changed. If you do a flexible tenor debt sculpting, your debt gets repaid in 12 years. But the client has asked that, no, you have to make full use of 18 years. So your DSCR would be higher than 1.1x or lower than 1.1x. Okay, Vishal says 1. Anyone else? More than 1.1x. Anyone else? Okay, another response for one. I need one more response. Higher or lower than one? Okay, the correct answer is yes, indeed, it would be more than one because essentially you have higher cash flows compared to what you can afford. So, if you are not making, if your debt is lower as compared to what should be sized, you will have higher DSCR as compared to the minimum DSCR. So again, this calculation is in a financial model when we want to make full use of the tenor. So that's called a fixed tenor debt sculpting. So when we do financial models, that's a financial build question. So we always confirm with clients that whether they want to sculpt the debt as a flexible tenor based purely on DSCR sculpting, or if you are sculpting a debt based on a fixed tenor based on the term sheet. Or the third option can be that you do a debt sculpting such that your tenor is also achieved and your DSCR is also achieved, but then you have to change the debt size. So then the problem is to calculate the right debt size rather than the debt sculpting, because that's a result. Debt sculpting becomes a result of your debt sizing. So if you size the debt properly, let's say for any project, uh, you will have the make you will be able to make useful of the tenor, make full use of the tenor, and you will be also have the same minimum DSCR throughout the period. So that's how we do the debt size. So that's the maximum debt that the project can take. Clear? Yes, no? Okay, so yeah, I think that's the end. We have like 10 minutes if anyone has a question. Otherwise, if no questions, and if you don't have any questions, you can feel free to leave the class. I think that's fine. But again, I just want to thank everyone for your time, and you will get the recordings and the certificates mailed to you over the next couple of days. Okay, so there's a question that I have a project where it has been classified risky due to higher credit risk profile of the off-taker. Right. So I think if there's a cash sweep condition on the loan, that's primarily because they want to restrict the developer, I'm presuming this is you in your case, to take out money from the project in form of dividends or in shareholder loans. So basically, if there is any excess uh, compared to the minimum DSCR that has to be maintained, first the debt will want to be repaid. So the sculpting still happens on the base case as the full tenor, but in case your project performs better, lender wants you to repay their loan at a much faster pace. That's why they put in the cash sweep condition. This is usually used for riskier projects wherein they are not sure of the cash flows or the CFAs that would be received from the project, and they want to limit their risk, and they want you to avoid taking out your money from the project. So the equity distributions are limited in a cash sweep because any excess cash will be first used to repay the loan rather than for dividend payments. Clear, Vishal? Okay, anyone else? Any questions on the model review? I hope everything is clear. Does lender consider risk based on shareholder percentage or share control basis? Oh, sorry, I think the lender, if it's a project finance transaction, the lenders would primarily be worried about your cash flows from the project and the certainty of the cash flows. So it's all about cash flows for lenders. I don't think the shareholder percentage or share control really comes into play. Imran, is this a PF transaction or it's a corporate transaction? It's an M&A or is it a project finance? PF, yeah. So for PF, I think they would be more considered about the CFATs. The only thing that they might be asking about this is if they think that the O&M company is also owned by the same developer and they see that there might be a leakage in terms of either asset management fee or in terms of O&M margins uh, before the CFATs are computed. So that's the only reason they might consider it for C. Otherwise, they would be family considered with CFATs. Just I think people have started leaving, so I think we will also send you a feedback form for our session today. So please fill that up. I forgot to mention that we would need feedback forms before we can actually give you certificates. That also helps us to get some feedback on our master classes and for future purposes as well. Thank you. Anyone else? We still have 5 minutes. If no question, it's okay. You can exit. It's fine. Okay, thanks, everyone. I think no other questions, so we'll end the session now. Thank you so much. Thank you for your time. Take care.